All right, Valentina, what were you saying?
You're in first place.
First place for what? March Madness bracket for the office? Wow. Okay, we got that on permanent record now. Hello and welcome again. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Thank you for joining us for our markets insights and observations. Today is Tuesday, March 26th of 2024. And yes, we're in the thick of March Madness. So thanks for watching, and let's get right to the three topics of the day that markets are paying attention to. Our three topics today, we're going to talk about sort of a global macro outlook as to the concentration of the S&P 500, what that means. Essentially, we have 7 stocks that led the way last year. Is that taking place again this year for year to date? As we get towards the quarter end, it's always something curious to pay attention to. Treasury issuance today is about $65 billion in Treasury issuance on the 5-year T-bill or T-note there. And so U.S. Treasury is literally going to the market again and rolling Treasury debt, and then the U.S. dollar. We'll take a look. But let's talk about the concentration in the larger market itself. Concentration risk. What that means is it's larger than it's ever been. So at the year end last year to going back to 2022 and 2021, 30%. Oh, let's see what this is. 30% of the S&P 500 in terms of market capitalization is in the Magnificent Seven. And the Magnificent Seven are 7 stocks: Amazon, Apple, Google, Meta, Microsoft, Nvidia, and Tesla, that constitute the Magnificent Seven, in case you haven't heard about that. Now, the concentration is larger than ever, as we just said, in the top 7 names, now 30% of the S&P market cap, eclipsing that 2021 level. As you can see, the tech leadership has not hit that level ever seen before relative to the S&P 500. So it opens the door for what we call a reversion to the mean. So it doesn't mean that the Magnificent Seven, those stocks we just discussed, won't continue to grind higher as sort of markets go through the day-to-days. It just means that they led the way to where we are, to the market's new highs. The good news is we're seeing under the hood, as we've discussed before, and as we're seeing play out, the broadening out effect, meaning that this concentration will come down. Doesn't mean that those stocks have to come down. It just means that the other stocks or other sort of, 493 sort of kids in the class start doing better on their tests that they're turning in. It's essentially, just think about like the A students, 7 of them are all getting A's. Now, will the A students continue to get A's? Absolutely. But can the A students sort of take a day off and get a B from time to time? There's nothing wrong with that unless they're trying to get scholarships to go to college. It's just the rest of the class has to play catch up and start turning in on better grades. And that's what we're seeing, the broadening out effect, where we're seeing money being pulled out of this Magnificent Seven and then put into energies, companies or sectors. Financials, we're seeing that play out as well in a positive way. Industrials, 25% of the S&P 500 last week were in sort of all of those other sectors for 52-week new highs. So that broadening out effect, as we suspected would happen if the trend and the momentum and this sort of market to continue on a positive note, is happening. Now, we could see a pullback month end. We're seeing the last 3 days of sort of the quarter end, if you will, of just a close to 10% on the S&P 500. So this year end or quarter end rebalancing, and maybe that rebalancing continues as we get close to April 15th and people are sort of positioning their liquidity accordingly to pay taxes as well. So this is a seasonal effect of a quarterly rebalance and preparing for taxes. So for the market to pull back and reposition itself, broadening out, that's not uncommon this time of year. Now, I just talked about 85% of the issuance is in short-term T-bills of the U.S. Treasury, which is the highest that we've seen since 2002, which is absolutely insane. And it's a 2-decade high. And what that means is that all of the U.S. debt is super short-term. Okay, and now that means that also there's about $10 trillion in bonds that needs to be refinanced this year alone, and those refinancing are not going out more than 1 year. So what is that telling us? It's telling us that the U.S. Treasury, Janet Yellen, head of the U.S. Treasury, is betting that interest rates will be lower than they are where they are today. So a year from now. So she's keeping everything short, basically going to have it roll over, and once it rolls over, she'll get lower rates in the future. major bet with a lot of money, 85% of the issuance of the U.S. Treasury. So what if she's wrong? That's a big friggin' what if she's wrong. Pardon my French here, but if interest rates stay where they are or even rise for whatever reason between now and next year, the debt service on our interest for the U.S. debt is incredible. We're already 120% debt to GDP right now. That could make things into, they call it a debt spiral. So that's something to pay attention to. Markets are paying attention to. And so this liquidity that's being provided and this turnover and for shorter rates is very important for everybody moving forward. And then also the U.S. dollar has rallied a bit, but they could see a little bit of stall as it's either A, it's near overbought, or B, the interest rate cycle could be lowering this summer as Federal Reserve Chairman potentially is looking for any data. Right now, the data is mixed, and it's not it's too noisy, as he used that exact quote, to actually find something to justify a rate cut, maybe June, maybe July. This Friday, we got another jobs number. Jobs numbers are continuing to hold in strong. Housing is the other component. It's sort of cooling off with regards to rent. But that CPI number, and you can't inflate or food and energy because energy is now kicking in. But that CPI number is trying to hopefully trend lower so that the Federal Reserve has the CPI, the PPI, any inflation number can sort of help them provide cover and justification to start the interest rate easing cycle. Not so fast. Once they start doing that, the ECB this summer is also looking to do that, as well as Germany and a few other around the world. So we believe that we're going to enter into, let's say we see markets pull back a little bit, but the next half of the summer, you could see a global sort of rally as it relates to interest rates coming down. If interest rates coming down, you're going to see rotation from large cap tech, if you will, to small caps in the U.S. You're going to see a bid in emerging markets. You're going to see another $2 trillion of liquidity hit the market both here and around the world. It could keep rates higher as a result of that. It could keep inflation stubbornly high because all of that liquidity is, all of those dollars are chasing goods and services. So it's a supply and demand imbalance. And that could go against all the central banks. But the central banks are setting up for right now an easing cycle. And as they do this, we can see sort of markets extend the rally later this summer. But we wait and see. A lot to sort of digest, a lot to look towards at the end of the quarter right now. And essentially, that's what we're seeing play out in today's market. So thanks for watching. Till next time. And hopefully your brackets are still intact for March Madness. We are trying to do our best here at Blanke, Schein Wealth Management. So go U of A Wildcats. We'll see you guys later. Have a good one.